Loving the pacing with which we start our 2022 show with Jeremy Siegel now joining us, a professor of finance at the Wharton School of University of Pennsylvania. Give us your sense, Jeremy, as a man who really does seem to be someone who believes in equity markets continuing to rally. How much further, how much faster can they go?
Well, I think they're going to confront some bumps going forward, because I think inflation, as you know, I've been a hawk on inflation, saying it's going to be much worse than what the Fed has said. And I think there's going to be a lot more rate hikes than is now predicted. I would not be surprised to see the short-term interest rate go to 2% by year end. So the stock market has to confront that. But that old saying that we all know, Tina, there is no alternative. In an inflationary environment, you want real assets. Stocks are real assets. Bonds, I mean, look at bonds today. I think a lot of people are looking back and saying, well, why do I want to hold dollars when inflation is 8%? And I see the stock market doing well in the first half, bumps coming toward the middle, still an up year, but not as much as 2021.
So, Professor, if we do see a real spike on the short end of the curve here, and you have folks start to question some of the valuations in the stock market, at least on a real basis, you know, factoring in inflation, factoring in that rise in rates here, does that sort of portend that maybe additional gains, at least at the same scale that we saw in 2021, may not necessarily be in store this year?
Yeah, perfectly. And especially, as we know, for those so-called high-flying tech stocks that are selling at multiples of revenues that don't have earnings, because if rates are going up, you're discounting the future, and those discount rates goes down a lot. Now, last year, growth still did beat value stocks by a few percentage points. I think the tables are going to be turned this year. I think people are going to be searching for those dividend-paying stocks. Don't forget, dividends on stocks are basically real yields. They're inflation protected because they're based on real assets. You can't find anything in the bond market that I see attractive.
Okay, on that note, when does it become attractive? You talked about hitting the 2% on the front end of the market. What yield is attractive enough where you don't have Tina in the stock market?
Well, I think right now we're selling around 21 times this year's earnings, 22, above the historical average, but still not that expensive, certainly with the interest rate levels as they are. If you take out the tech or the FANG stocks, you're selling at 18 times earnings. I still think it's a reasonable stock market. And I think that people, even though they're not going to like those higher rates, are saying, well, where am I going to go? I mean, they can go to real estate, which I think is still going to do well this year. They're going to go to real assets, which is going to go well this year. Some commodities well this year. What won't do well this year is those assets that are only denominated in dollars.
To that end, talk to us about the dollar, because the dollar just pushes up. I mean, I think it's having its best day since mid-November at the moment, as people start to see the appreciation of yields. They start to potentially think that still, as Federal Reserve Fed Chair Jerome Powell has said, the reason yields remain so low is because money's coming from abroad. It still looks appetizing to buy into U.S. yields right now.
Yeah, we are above the rest of the world, but our inflation is above the rest of the world. So we economists say if there's a lot more inflation in the U.S. than the rest of the world, the dollar should appreciate. But in the short run, people just look at the yield differential, and if they see the 10-year going up and short rates going up, you will see strength in the dollar. However, you take a look at the trade deficit reaching all-time record, a lot of dollars are flowing abroad. So I'm not sure by the end of the year whether we're going to see that strong a dollar.
What about with regards to some of the developing nations that aren't really developing nations anymore? And I'm referring to China here, and the competitive pressures between investment dollars, which seem to still want to go to China. Of course, the U.S. is always going to be the U.S. I'm wondering how investors sort of weigh, I guess, the pros and cons of both of those scenarios.
Well, you're perfectly right. I mean, international investing has been a great disappointing. Emerging markets, which, by the way, sell at very reasonable 15, 16 times earnings with yields of 4%, 5%, many of them just are not attracting the dollars. The growth is in tech. Tech starred, as we all know, in COVID 2020 and 2021. Will the tables be turned this year? It might be. I mean, if you take a look at the valuation differential between the U.S. and Europe and emerging markets, it's nearly at an all-time high right now.
Professor, Goldman Sachs, even Morgan Stanley, I think, out with some big notes this morning, talking about the year of the stock pickers market. Is this the year for further active management?
Well, you know, I've heard that before. And then when we come to the end of the year, all the active managers underperform. I mean, how many outperformed S&P last year? It must be nearly a record low. So, you know, I hear that. Sometimes I hear it from people who want to justify the fees that they charge. However, given the fact that, you know, maybe we're going to see a value resurgence, some of those non-FANG stocks might do well, and we might finally see some of the stock pickers overperforming the average in 2022. But certainly, if you take a look at last year, or really the last 5 years, certainly that has not happened.